Happy New Year, everybody. Welcome to this Monday, January 6th edition of Trading Places Live at EarningsBeats.com. I'm Tom Bowley, Chief Market Strategist here at EarningsBeats.com, and I'll be your host for the next 30 minutes, featuring everything you need to know as you prepare for the trading day ahead. Wow, can't believe we're into 2020, new year. Hope everybody had a great holiday season. Hope you were able to visit with your family and friends, have some good times, maybe watch a little football yesterday, Saturday, some great games, by the way, in the NFL over the weekend. But this isn't about football. This is about stock market. So let's jump in here. I do want to just mention that we had a great event on Saturday. That was Market Vision 2020. It was highly anticipated. It was our first online conference at EarningsBeats, and we had just an absolutely outstanding group of speakers, including John Murphy as our keynote speaker, and then a lot of my colleagues at Stock Charts, a lot of the folks I've been writing alongside for the last several years, in some cases probably up to about 15 years. A lot of them on there to join us and give their outlooks and some of the things that they're looking for as we go into a new year, a new decade with markets sitting at all-time highs. It really was a great event. For those of you that were able to join us, thank you so much for supporting us and supporting that event. And for those of you who were unable to make it, we have recorded the event. So I want to make sure that you are aware. And let me go ahead and show you. This is a sign-up page, and it might be familiar. But if you do go in here and put in your name and email address and submit it, we can get back to you with information on the recording. So if you were unable to make it, you'd like to go back and access the recording and check out what all the great lineup that we had, what everybody had to say about 2020, there is still that opportunity. So go to EarningsBeats.com. So if you just go into EarningsBeats.com, and then at the top there will be a tab for Market Vision 2020. Simply come in here, and you'll see if you put your name here, we'll make sure you get information on how you can access the recording of the event. Those of you who already paid for Market Vision 2020, whether you attended or not, we'll make sure you get a copy. I'm really just talking about those who were unable to make it, who did not register. If you do want access, just simply put your name and email address in here, and we'll make sure we get back to you with that. All right, let's move on to what happened in the market on Friday. Of course, everybody woke up to the news of the airstrikes in Baghdad. And futures immediately took a big hit to the downside. But overall, I would say that the reaction was rather muted. We were still down 233 points. I think probably all of you or most of you would agree if we'd had this news during those fearful periods back in 2019 or in the fourth quarter of 2018, we probably would have seen a lot more negative reaction to it. But the market it's kind of been on autopilot. We've had the volatility index very low. The market tends to accept bad news without a whole lot of volatility when we see the VIX down at those levels. So we got the big gap down, but you can see here on the charts, we actually had a red hollow candle. And what those red hollow candles tell us is that we closed above the open. So all of the weakness basically came at the open. We saw a little bit of selling in intraday early on, but then the markets rallied. It told us that there were buyers out there. And that tends to be what you see in a bull market advance. Even when you get bad news, you still have buyers. So I know there's a lot of negativity over that, and I'm certainly not getting into all the political ramifications, but none of us know what kind of response we may be looking at from Iran and the repercussions going forward in the Middle East. But what we need to focus on is the charts. And right now we're in an uptrend. I'll show you the S&P 500 in a couple minutes over some various time frames. But as I look at the charts, I'm not seeing anything that suggests we're going to have any kind of a big sell-off. But you can see the Dow down 234 points on Friday. The S&P was down 23. The NASDAQ down 71. Small caps, after gapping down, actually came back up and closed in positive territory. Thought that was an interesting development on Friday. We'll see whether or not that continues into the balance of January. I actually like small caps in 2020. I believe they will outperform from now to the end of the year. I will be surprised if small caps do not outperform the S&P 500. The 10-year Treasury yield took a big dive on Friday with that news of the airstrike. Not too surprising there. Equal highs up here in the mid-190s. I would probably like to see, well, I definitely would like to see these recent lows in the upper 160s hold, but we could be looking at an equal high, possibly even higher low, maybe an ascending triangle. Let's see how the 10-year Treasury yield moves here over the next couple of days. And remember, we've got a big employment report out on Friday. We've got the ADP employment report Wednesday, but then non-farm payroll is the one that most everyone watches, coming out on Friday morning. That's going to tell us a lot more, I think, about the 10-year Treasury yield than any of these geopolitical concerns. Looking at the various industry groups and sectors, well, let's start with sectors. We've got real estate performed well on Friday, utilities, not at all surprising. These are two groups that are defensive. When the market sells off, this is where we usually see money rotate to, just like money rotates to treasuries. And when treasury prices go up, the yield comes down like it did here. Well, as treasury prices go up, usually you see real estate, utilities, consumer staples, those types of areas do well. And that's what we saw on Friday. Materials were down. Technology had a little bit of a rough day, down over 1%. But again, it's been a straight up move. We were at 77 back at the beginning of October on the XLK, and we just went up over 93 on Thursday of last week. That's a huge move, more than 20% in one quarter. So it's okay if you have some weakness and you consolidate. Actually, I'd really like to see a basing period for a while on some of the areas that have performed so well the last 3 months. Also want to mention defense stocks. As you might imagine, with the airstrikes, the defense stocks got a lot of attention on Friday. Big breakout here above this double top around the 515 level. Ended up closing up at 530, was up more than 3% on Friday, and that was after a pretty good day on Thursday as well. So defense stocks getting off to a very strong start to open 2020. All right, let me pull up the 10-year Treasury yield and just take a look at this for a second. This is just a bigger chart, so we can get a little bit more perspective here. But this was an area where we had broken down back in August, 1.95%. And if you notice, last 2 rallies have ended at 1.95%. It would be a big deal for us to hold these recent lows and to turn around and go back up. Because one of the things we know, or we should know, when the 10-year Treasury yield is rising, it's a sign of economic improvement or the anticipation of economic improvement. And that generally leads to higher stock prices. So typically when you see the 10-year Treasury yield moving up, that normally coincides with a very strong advance in the S&P 500. If you look back to where we were at the beginning of October and where we were toward the end of December, you can see that represents money rotating out of treasuries. So you've got treasury prices falling, and as treasury prices fall, yields go up. So that's when you see the yield rising, it's telling you folks are getting out of treasuries. And that normally means they're getting into equities. Almost, if you go back through history, just about every rally in the 10-year Treasury yield coincides with a strong rally in the U.S. stock market. So that's going to be something to watch in 2020. If we get this breakout above 1.95%, ignore anything you're hearing on CNBC. If you get the money rotating out of treasuries, you want to be in equities. All right, let's talk a little bit about the S&P 500. I wanted to go over a couple time frames here. So let's look at the S&P 500 first on this daily chart. What I see since October has been a straight move higher. We've got a little bit of a negative divergence here, higher prices, and with the PPO rolling over slightly. So I would say that currently we've got maybe a little bit of a warning sign, but that's a slight negative divergence. If we break out again, there's a very good chance this PPO would turn right up and eliminate that negative divergence. So yes, I would recognize it, but I wouldn't get overly concerned. I mean, you can see actually back at the end of November, higher prices, lower PPO. We did come down, printed a hammer just below the 20-day, and then we took right back off again. The PPO did not reset back at the 0 line. We never saw a 50-period test, and those are the two things I tend to look for after a negative divergence. We didn't get either one of those and just took back off with volume picking back up again in December. So really good action on the S&P. Again, short term, yeah, maybe we've got a little bit of negative divergence we need to be aware of, but I wouldn't grow overly concerned there. From a weekly perspective, look at this chart. I mean, this was the basing period, in my opinion, 2018 all the way through into September of 2019. I remember writing about when the Fed came out and lowered rates, and so we saw that initial reaction just the last 2 hours of trading that day. I remember we had almost like an impromptu webinar, and we said things are changing. You might not read a whole lot from just a couple of days, but the trading that took place right after that meeting told me that we were in a different ball game. And look at what happened since then. We've been straight up. The market gives us signals. I know there are a lot of folks out there, and I'm sure not too many in this room or you wouldn't be here, but there are a lot of folks out there that don't believe in technical analysis. I feel bad for them because I think technical analysis is much, much better than fundamental analysis. I like to combine the two. I like looking at the economic picture. I like looking at earnings, but I will take the charts over all of that any day. The market has a lot of really smart people going out. Well, they've got economists on their staff. They've got people going out, analysts going out to companies, talking to management. They have a whole lot more information than we have. So if you can follow the price action and see what the market's telling us, not just the fact that we're going up, but what's leading, those are all really important questions. And that's where the charts come in. I mean, I look at my relative strength charts every day. The weekly you don't need to look at every day, but I like to see what's going on in the market every day. What's leading, what's not. Is it fitting, into that big picture story that I believe has been written? And if it's not, at what point should I be concerned? And so I think all of those factors are things that we should be thinking about. But here you can see the huge move up. Yes, we're going to have a pullback at some time or at some point. I don't know when. I mean, when you look back in history, this was consolidation period. But if you go back to 2017, if you're waiting on this 20 period test, we got close here, didn't make it, broke out. We got close here, didn't make it, broke out. Close here, didn't make it, broke out. Finally, months later, I mean, here you can see we were very extended. PPO up near 3. Where are we at now? PPO up near 3. And you might look at this and say, wow, this is really high compared to anything we've seen over the last couple years. I want to get on the sidelines. Well, if we stretch this out and go back the last 20 years, I think you'll see that we are not anywhere near the most overbought we've been. Here we've had readings up, well, back in 2009, coming off the lows, we had readings up closer to 4, over 4, close to 5. Here we're sitting on this weekly chart, 2.71. So yes, we're getting extended. Yes, we're overbought. Yes, we could pull back, but we also could continue to move a lot higher even with these overbought conditions. So this is not the time for me to be thinking of bearish conclusions. I don't want to be shorting for sure. I mean, if you want to take a little off the table, or if you're in aggressive stuff and you want to move to maybe something a little less aggressive but remain on the long side, I completely get that. But to be thinking shorting or to be thinking bearish outcomes, I would avoid that. Let's move down to the hourly chart. I mean, the hourly chart, we're just kind of going sideways. We're kind of showing a little bit of action below the 20 hour, above the 20, back below the 20 on Friday's close. Today, futures are down. I could see more sideways consolidation. Perhaps watch this gap support area in here. I would say closer to 32.05 to maybe 32.15. That's going to be an area to watch short term. Now, if we break below it, I'm not saying, look out below. I'm just saying the short-term chart would be violated, and then you'd want to go and take a look at the daily chart where you've got the 20-day moving average at 31.99. So again, if you lose that 32.05 is what I just told you on the gap, in terms of gap support right here. But here is your 20-day moving average. A 20-day test is just kind of a normal pullback. Nothing really to be too upset about. I mean, that's going to happen from time to time. So anyway, keep all this in mind. The time frames and all, I think, still look good. I try to really avoid the news. I mean, you can't really avoid the news of an airstrike over in the Middle East. But the market, at this point, the strike itself is not changing anything economically for us. We'll see what happens in terms of maybe a potential retaliation and what that might mean. But for right now, I think, a lot of folks jumping into the defense stocks, which I don't know, kind of makes sense given the fact that tensions now between the U.S. and Middle East have escalated. And, if I pull up that chart, let's look at this chart. Here's your defense stock. There's your top, second top, and there's your breakout. If we go out, look at a weekly chart on defense stocks, you can see there was also a top in 2018. This is a pretty significant breakout in the defense group. And this was a group that was struggling for a while versus the S&P 500. As it was going sideways in the fourth quarter, the S&P was soaring. So on a relative basis, not performing well. This breakout could definitely change that. So defense stocks, any defense stocks, if we get a pullback back to about 500 to 510 in this area, I think defense stocks would absolutely be in an area to be thinking about. All right, I want to move on to another topic, and it was one I mentioned in the EarningsBeats Digest this morning. And if you're not a subscriber to that, it's free. You absolutely should go take a look at that. So if you go in here to EarningsBeats, on our on our homepage right here, you've got subscribe to free EarningsBeats Digest. Monday, Wednesday, Friday, no charge, no credit card, just really good information about relative strength, about earnings and so forth. Just, our community service as much as anything else. So make sure you sign up for that. But in today's EarningsBeats Digest article, I wrote about energy and specifically this group, which, and I'll show you how I got here, but over the last month, 1 month period, the best performing group relative to the S&P 500, you might not believe it, but it's oil equipment and services. And when I look at this chart, I'm seeing improvement. I'm not ready to just jump in here and, overweight this group. We have seen this before. You can go back to 2017, late 2017, second quarter 2018. I mean, it looked good. You got the PPO rising. Both cases here, we even went above the center line. But in those cases, we ended up tumbling back down. And I'll show you more on that chart in just a minute. But if you look at this, the way I get here, and if you're a annual member of EarningsBeats, you have this chart list, or at least if you're at least an extra member of Stock Charts and an annual member at EarningsBeats, we will send you this chart list, which is all of the industry groups on a relative basis. Really a cool chart list to have. But what I do, let's just say I'm on the S&P 500 over at Stock Charts. So what I do is I go in, find my chart list, which is here, Relative Strength Industries, pull it up. I go to View All, change this to Summary. This gives me all of them, and then I sort it based on the 1 month results. And there you go. So this just tells me over the last month. If I want to know what's been leading the market over the last month, this tells me. If I want to know over the last week, what happened last week? Coal had a good week. Defense, all right, we just talked about defense. This is just a great way to see what's working. And also, click on this change column, find out what's not working. That might be just as important. You don't want to be jumping into an area that perhaps is breaking down on a relative basis. So you want to keep these areas in mind. And a lot of times I'll just quickly look at the sector and just see, okay, materials, few areas of the materials not doing well last week, couple real estate areas, consumer discretionary, consumer staples, so maybe consumer stocks. You can see a couple more here. So those are the ones that I can see last week quickly didn't perform very well. And there's your 1 month. Now, again, I'm going to go, anybody in here who's not a big technical analysis fan, I'm going to show you something. Maybe it'll change your mind. Maybe it won't. I wrote an article back on November 16th. So this was almost 2 months ago. And I talked about 2020 market outlook. I was announcing the Market Vision 2020 and also gave a turnaround candidate to consider in an unlikely area. And if you scroll down here, I went through a couple themes. And I said, theme number one, this was back in mid-November, energy rebounds. And I just talked about the fact that there's a good chance global economic growth would return in 2020, that it'd be better than a lot expected. And if it is, that would send crude oil prices higher. I don't know if you've been looking at crude oil prices, even before Friday. Crude oil prices have been on the move to the upside. I pointed out the symmetrical triangle. That's been broken to the upside. I was expecting it. As you can see here, see a potential symmetrical triangle forming, which is a bullish continuation pattern that we'd expect to break in the direction of the prior trend. There's your prior trend. Here's your symmetrical triangle. It broke to the upside. So that's not, some people say, well, technical analysis is just telling you what happened. No, it's not. There's a lot of patterns. There's a lot of things that can give you clues. Now, does this mean you want to jump right into energy that day? Probably not. I mean, maybe you wait for that breakout. But that is certainly something that was catching my eye. Maybe even more important was theme number 2, which was a weakening U.S. dollar. One relationship that I watch really closely is the treasury yields in the U.S. versus the treasury yields in Germany, which is, for me, I don't know, it's just kind of like maybe the European barometer. But I really like comparing the U.S. and Germany. I think correlation between our two countries is as strong as any two countries, or at least as any other country with the U.S. going back many years. Some people write to me and say, well, no, some other areas are much stronger correlated. And they say, just look at the last 6 months. And I'm thinking, no, that's not what I'm referring to. I'm talking about long-term correlation, very strong correlation. When the treasury yields in the U.S. are going up faster than Germany, that's a sign that our economy is stronger. The dollar rises. Here's the strength in the treasury yields here in the U.S. versus Germany. Here's the strength in the U.S. dollar. And when you go down here to the bottom, correlation, we're almost always in positive territory between the direction of the treasury yields in the U.S. and Germany, or versus Germany, and the direction of the U.S. dollar. Well, when the dollar is strengthening, commodities struggle. Energy, look at energy coming down. Now, the thing here with this was, look at the weakness over the last 9 months in the U.S. Treasury yield versus Germany. And yet the dollar kept going higher. So these red areas are when we see negative divergences. It's when the yield's telling us one thing and the dollar's doing the opposite. Each of the 3 prior times that this happened, we had the yield going up and the dollar going down. And it was the dollar that rebounded to get things back into track. And looking at it, look at the correlation. Goes negative, goes negative, goes negative. Each of those 3, we had the dollar going down when it should have been going up. And then look at the dollar explode up, dollar explode up, dollar explode up. Now we've got the yield going down, the dollar still trying to move up. And so this is where I said, you know what? The dollar could definitely come down. And I was looking for it maybe to come down here. That would be about a $6 drop in the US dollar index. If that happens, energy would be expected to lead. Crude oil prices break out, energy would be expected to go higher. Let me just show you this chart updated. We continue to go lower. We're now setting new lows on our yield, and look at the dollar starting to rotate and roll over back down. So hopefully you can see that using technical analysis, using the, let me see, I don't want to, all right, let's get back to that. Using technical analysis, using these intermarket relationships, really important. So I went on to say, okay, how about Halliburton? Halliburton, the last time that oil prices went moving higher, or when the energy went moving up versus the S&P, crude oil prices went moving higher, and Halliburton doubled in price. And that was less than a year. So I was looking for it maybe to at least get back up to 25. Well, it has now gotten back to that 25 level and above. So I think this is a good example of how you can use technical analysis to spot things before they happen. And that's really important to me. Here's a chart of the dollar. You can see this over the last year. But we topped back in October. I wrote my article right in here, mid-November. I think it was Saturday the 16th, so right about here. And this is what the dollar's been doing. So we're going to want to watch the dollar. I think the dollar could easily go back to these lows that we saw back in early January, maybe back to that trend line, 92, 93. If that happens, gold, energy, some of these commodities are going to be something to look for. All right, couple upgrades and downgrades before I get into the 3 you must see. Google was upgraded today. There's no earnings, by the way, so that's why I'm going to focus on just upgrades, downgrades. Earnings will be kicking in pretty soon. Google's getting upgraded. Nice move up. I like Google. Google continues to perform well relative to the internet. Internet groups breaking out. I agree with the upgrade. GNTX is upgraded today. This is Gentex Corp. Looking at the strength here versus the auto parts industry, I think it looks pretty good. Had a huge move on a relative basis. I think it's been consolidating. A lot of sideways action here. Move up, cup, handle. They're upgrading. Can't disagree with this one at all. JWN, Nordstrom's. Nordstrom's really has started to improve quite a bit. Talked about this one in the past. This was a little bit of a hiccup for sure. But other than that, it's been a straight move up. And we did get a lot of nice volume here on this gap up and another breakout. Relative strength's been picking up for the last 3 or 4 months. I think this is not a bad upgrade. Downgrade. Apple got downgraded today. I think it was Needham that downgraded Apple. And what I found really interesting is they had a price target of 280. They raised it to 350 and then downgraded the stock. So they downgraded from a strong buy to a buy. So it's still a buy. But if you think the stock's going to 350 and it's at 300 or 297, I would think it would still be a strong buy. But I don't know. I don't know what the criteria are of some of these firms. Again, I just like to follow the charts. Apple's been a great performer. Could it pull back? Yes, it needs to pull back. When you get these huge moves in Apple, and we've seen plenty of them over the years, they're generally followed by a period of basing, consolidation. I don't know if that's going to start now, if it's going to go up another 10%, 20% before it finally starts to consolidate. I would say if it doesn't start now, it'll probably start about the time earnings come out. I think once we get the news, this is all the anticipation. This is the rumor. So, a lot of times we'll get stocks indices to move higher on rumor, and then they sell off on news. That looks like something that could happen here with Apple. So if the stock goes up and then the stock comes out with great earnings, which I absolutely expect is going to happen, why else would Apple be doing this? You could get a gap up and maybe a big red candle. If we get that, or a big black candle, that could definitely mark the top for a while. Watch for that if you hold into earnings. All right, let's move on. We're going to wrap up the show today like we always do with the 3 you must see. I figure in a market that's going into a new decade with all-time highs, we got to look at some breakouts. So I'm going to start with 52-week highs. First one I want to show you, and I could talk about defense stocks because a bunch of those broke out. We already talked about defense. I'm going to stay away from that area. Let's look at Cogent Communications Holdings, CCOI. Nice breakout here. First of all, we had a nice move through July. Went through a period of consolidation for a while. Look at those. That's really bullish candlesticks right there. 4 days in a row, increasing volume. Breakout, pull back. We're almost to the top of gap support. Not quite. Then we turn back around, breakout again, volume picking up. This is a stock that looks like it's showing some nice relative strength versus the internet. Nice volume trends, making new highs. So I think Cogent is one of the 3 you must see here. Next up, this is a software stock, Pegasystems. Software's been rolling here over the last couple of months, and we're starting to see some strength here. But we had broken out above the July high on the index back in November. We're just now breaking out above that July high on Pegasystems. So the volume again picked up last week. We did get that move higher. I like it on a 20-day test if it gets back down. Doesn't have to go down too far, a couple bucks. But that 20-day test, a lot of times you get a breakout, you come back down, you don't hold the breakout, you go just below, hit that 20-day, and then move back up. If we see something like that, that's something I would be very interested in. So again, Pegasystems, PEGA, I think looks pretty good here. On a relative basis, I'd be much more concerned if this relative support down here fails to hold. Instead, what you want to see now that we've got the breakout, I want to see continuing outperformance on PEGA. All right, let me get a drink of water for my last 3 of the 3 you must see. All right, this one is GLPI. This is gaming and leisure properties. If the market does consolidate, then look for real estate to kind of come back up and lead again for a period of time. We saw that on Friday. If you're a little nervous, I said, you could get a little more cautious. This is the type of stock. This stock yields, it has a dividend yield of about 6.6%. It also is gaming and leisure properties. We've talked about gambling stocks. They've been doing very well. So you got a real estate group that's maybe being supported by a strong industry group, breaking out to new highs, even though real estate has not. And you can see the group, its industry group's been going down. You got a real nice leader paying a 6.5% dividend. GLPI certainly is one that I would keep in mind. All right, that is it for today's Trading Places Live. Again, I hope everybody had a great holiday. Happy New Year to everybody. We're looking forward to a great 2020 here at EarningsBeats. If you're not a member, we'd love for you to join our community. We do have a $7 trial offer. Make sure you check that out. All right, that's it. Everybody have a great trading day, and be back on Stock Charts TV with Trading Places Live tomorrow at 9 a.m. Have a good day, everybody. Happy trading.